Welcome to part 4 of the Cash and Liability Mastery series. Today we'll dive into understanding credit scores, and how they affect you. Whether you are aware of it or not, you are playing the credit game. In this day and age, you generally don't have a choice unless you manage to live in an all-cash world. How well you play will have a big impact, and it's important to pay attention to how well you play it. I'm hoping I'll teach you some points that will help you to play the game better. Just like any game, the credit game has a score. It is a 3-digit number lenders use to evaluate how much risk you could potentially be to them. The most widely used score is what we call a FICO score, which has been in place since the 60s, and scores range from 350 to 850. If you are going to lend someone money, in a way, you are placing a bet, and the bet is on that if that debt is going to get paid back over time. If you are lending to someone with a credit score above 800, you have a 1,292 to 1 chance that the loan will get paid back. That's a pretty safe bet. If you look at a 500 credit score, 1 in 8 people will default on that loan. If you're going to make that loan, you are definitely going to hike up the interest rate to make the return worth the risk. It's important to realize that the game of credit is played individually. When a couple applies for a loan, it's the lowest score that is going to be used. Credit scores don't just affect you in borrowing. They can also be taken into consideration when shopping for insurance, signing up for utilities, and for employment purposes, among other things. We want to achieve the highest score possible to minimize our costs. Let's look at some numbers. 80% of Americans have 1 or more errors on their credit report. 40% of Americans are paying a higher mortgage payment due to lower than necessary credit scores. 25% of Americans have credit report problems that would prevent them from securing a loan or new employment. Let's look at the financial impact of a lower score. If we look at an example of a $260,000 mortgage loan, the annual mortgage payment for the worst credit score is $8,736 higher than the best score. That's $728 more each and every month. Over 30 years, you would have paid over $1 million more for having bad credit. Think of this a little differently and look at the number if that excellent credit borrower invested that $728 a month difference. At the end of 30 years, their house would be paid off and they would have over $1 million saved up. If your score is anything but the best, then you are paying more interest for the same borrowing. When talking about mortgages, it's important to note that 70% of your ability to access your house money is tied to your credit score. Knowing what does and does not affect your credit score is a big part of playing the game. Let's look at what does not affect your score first. Notice that income does not affect your score. So you might make $10,000 a month and have $500,000 in the bank. But if you have a 620 credit score, you're still going to pay more for the privilege of borrowing money when you want it because income and net worth don't impact the score. There are 21 things that impact your score, and I understand that can feel overwhelming when trying to play the game. But we're going to simplify what impacts the score by looking at the 5 key areas, because all of those 21 things funnel into those. So the 5 basic rules. Payment history makes up 35%. Your utilization rate makes up 30%. Length of time is 15%. The types of credit you have are 10%. And inquiries are 10%. If you can manage those 5 things, you can control about 80% of the best score you can get. One thing to understand is credit score models are different for mortgage lending versus car loans, etc. They all follow the same basic parameters, but they have a little difference in their predictive modeling. That's why you might buy a car and be told you have a 740 credit, but apply for a mortgage the same week and be told it's 710. Also, mortgage lending uses a tri-merge report, where it looks at all three bureaus and uses the middle score. Along that line, there are credit monitoring services that don't use FICO at all, so you can definitely have some differences. Credit Karma, for example, uses a Vantage score, and this is how they weight things. Each bureau has to give you a free report once a year. If you are working on improving your credit, I recommend you pull one at a time so you can let some time pass before pulling the next to see what effect your changes are making. So, how to control what you can control? 35% is payment history. This one sounds really simple, but obviously takes discipline. Always make your payments on time, especially for any of the bills that report to the credit card companies. This one gets a little grayer. 30% of your score is utilization rate. What is that? It's how much of the average balance you use on a monthly basis in relation to the high credit limit. If you stay under 30% and pay it on time, you are getting the max score value. As an example, if you have a credit card with a $10,000 limit, you never want your balance at any given time to be higher than $3,000. I get a little worried suggesting this one to people because you should only do it if you are disciplined. But if you have a card with a $500 limit and you pay it off every single month, ask for a $2,000 limit. That will put you in this range as long as, again, you're only putting on the $500. This is how to manage revolving debt. But understand that with an installment loan, you always start at the max credit limit every time you open one up. In addition to credit limit, when you get an installment loan, you have opened a new account. So you go backwards a bit on length of credit history, which makes up 15% of your score. So that is why your score usually goes down when you first get a car loan, for example, and it will take 6 months or so of payments to bring that back up. If you open 3 credit cards at the same time, that would have a big negative impact on your score. That's why it's important to take future purchases into account when you're planning your finances to protect your credit score. This length of credit bucket is also why it's important to keep all accounts open and active as long as possible. On your score in the model, you have an average open credit number. If you don't use an account for 12 months, it is treated as if it was closed. Under types of credit, it's helpful to have at least 5 accounts active at all times, 3 revolving and 2 installment. Now remember, this bucket only makes up 10% of the score. So if you currently only have 1 account on your credit report, definitely don't run out and open 4 more. What if you want to live the game being debt-free? That's admirable, but it does actually hurt the credit game. You can still be debt-free using credit cards if you pay them off every month, but using the credit will keep your account active and help your score, assuming you're staying under that 30% limit. Finally, inquiries. They do affect your credit score. There are 2 types of inquiries, hard and soft. Soft inquiries do not affect your credit score. If you pull your own credit, that is a soft inquiry. A hard inquiry is whenever a creditor pulls it to evaluate a loan application, and this will affect the score. So be careful what you're applying for. Hopefully this has helped shed some light on credit and credit scores. Please let me know if you have any questions.